Now let's head over to the bond market. With yields on the rise despite some weaker than expected economic data out this morning, Rick Santelli is in Chicago with our bond report. Happy Friday, Rick.
Happy Friday, Dom, and indeed you summarized it. The service sector data, which is still coming through the pipeline, was indeed disappointing. And the one that was a little bit higher than expected and sequentially higher than last month was prices paid. That's not the one you want higher. Of course, that means both sides of the Fed mandate were in question with respect to not only labor market and some of the employment reports embedded in these indices, but look at how the markets reacted. We basically made the low yields of the session, at least up to that point, right after the data that hit the wires. Then we proceeded to see yields move higher. As a matter of fact, right now as it sits, 2-year yields and 10-year yields are both up on the session several basis points. But on the week, they're each down about 8 basis points, and that kind of summarizes what's going on. And if you take it a step farther, as you look at those weekly charts, what's very important is that we tried to get down towards that 4% level on a 10, didn't quite make it. The low yield close of the year, of course, from early April is 4%. And there's something else for you technicians out there to pay close attention to. The NASDAQ index right now has a higher high and a lower low than yesterday. Should it close below yesterday's low, that would be a key reversal from all-time highs. That is hugely technically significant and could be bearish. If you get a green close, of course, it isn't necessarily going to change that it's an outside day, but it will change the notion of it being a key reversal. Dom, back to you.